And we're back to talking all things Fed. It's taken us a while to get here. Stock markets have been waiting and waiting and waiting ever since that big rip thanks to the Nvidia earnings last week. And not surprisingly, we're going to focus on what it is that they're waiting for, the Fed's favorite inflation gauge. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we are back to a familiar conversation here, which is who's afraid of a few Fed rate cuts between friends? Because what we see in financial markets here is standstill ahead of what is the next big iteration in the will they or won't they, and by how much, that has been so critical as markets weigh what the Fed is going to do and then reflect that back into asset prices. So what we're going to do here is we're going to take a look at what's coming up. We're going to take a look at how the markets have set themselves up to respond to these kinds of things, and then see what that means going forward and what the risks are across markets, both in terms of things that might go down, things that might go up, and sort of where the opportunity to trade some of this might arise. So just to kind of contextualize what we've been looking at here, if we consider the way February has played out so far, the stage-setting exercise for the month was arguably the January 31st Fed policy meeting. We can see that on the screen here. Was a rough day for the bellwether S&P 500. The Fed came out more hawkish than the markets anticipated, and they clearly didn't like it. But by the time a new month got underway, investors shook that off and said, okay. The Fed said that they're not going to race to cut rates. Could they have really been expected to say that they would? No, the Fed always gives us a degree of vagueness. Of course, they had to say that they're prepared to go the other way if inflation were to get out of hand. The U.S. economy has been getting a little bit better. By that point, we saw some PMI and some GDP data that was better than expected, that started to kind of get the juices flowing on maybe the U.S. economy is again looking a little bit more buoyant in the first quarter of this year as it did in the beginning of 2023. And we remember how that worked. Then we were looking at where rates would peak in the U.S., and as the data was getting better, markets bid up where that would be as high as 6% at one point. And obviously we never got there, because once they did, the markets shuttered. People started to freak out. People started to look for who can't bear rates at that level. Needless to say, they found SVB, they found Signature, and things started to come apart. So needless to say, the markets get a hawkish Fed and go, whoa, hold on a minute. Now that's not good. But then the month begins and they say, all right, wait a second, let's actually see some numbers. Let's actually see what this is going to look like, because of course the Fed is not going to pre-commit. And then we get a hot CPI number. And the markets go, okay, this is not a drill. We are, in fact, seeing more buoyant economic growth. By that time, we'd already seen, in addition to GDP and PMI, a hot NFP number, so faster jobs growth. And we talked about this ahead of that CPI release here on Macro Money and said, look, if you have an economy that's accelerating, you're going to have inflation that's probably pressured higher. So the risk on this CPI number is going to be that it beats expectations. That's exactly what it did. And stocks didn't like that either. Another big leg down. The difference there, though, is nothing rebuilds in a hurry. We get a couple days of retest, and then the markets come right back down to where CPI took them. It had to be another explosive set of earnings from NVIDIA, which you can see also marked here on the calendar, the darling of the AI will solve everything narrative, to get them to pop higher. And then, pointedly, crickets. The markets have not built on that story. The markets have not said, oh, goody, great earnings from NVIDIA. Everything must be okay then. Well, apparently not. Because ever since we got those earnings, nothing else has happened. S&P hasn't managed to do much of anything. And the NASDAQ, where this kind of futurism, tech, utopia, everything will be fine story lives, it's actually come off. And so, not surprisingly, there is a level of spook here as the PCE numbers, the Fed's favorite inflation gauge, come into focus over the next 24 hours because, not surprisingly, the markets are saying, well, we know how FOMC went. We know how CPI went. Here's the next big Fed inflection point data release. If it's hotter too, well, how's that going to go? Now, if we look at how Fed policy expectations have evolved, this is now the way forward as it is being priced into Fed funds futures. And of course, we've taken January out of the mix because January's contract has already expired. Now we're looking at the next one down and looking at the difference between that, so the current active contract on Fed funds futures, and the Z contract, which is December, the end of this year, and taking the spread to give us how many rate cuts are expected between now and the end of the year. And what we see is that as the year started here, we were looking at 6 cuts. This is 150 basis points down here, as you can see. What we're looking at now is closer to 75 basis points. So we've cut the stock of Fed policy easing that the markets are anticipating as essentially in half. Now, we notice that as we were looking at this in the second half of last year, we saw fewer cuts and stocks didn't like it. As the stock of cuts declined, so too stocks went down. Although you'll notice not immediately, with a lag. There is a period here where the markets go, fewer cuts is good news, up to a point. And when it gets to a breaking point, it starts becoming bad news. Now, why? Well, when you look here, why are rate cuts easing at the middle to give or take, sort of late first half, middle of last year? Well, because the Fed has made strides in containing that banking crisis we just mentioned, and because it's starting to look like there's not going to be a fiscal outturn that's negative from the latest round of debt ceiling negotiations. And so there's less need for the Fed to dial up stimulus. Risk is coming off. The markets go, okay, well, good. Good. We're not going to get a crazy credit dislocation from the regional banks for now. We're not going to have a fiscal headwind to growth because we can't agree on government spending for now. Take down these rate cut odds. And stocks like this, obviously. This is good news. Up until you get to a certain point. And then it starts being too few rate cuts for comfort, and stocks fall. It works in reverse. When rate cuts start to build back out, stocks rally. As the Fed starts to signal in November and December that, look, we're thinking we're done with hiking, we're thinking we've seen the peak in rates, and really shift the lens now to speculating on when the cuts will be and how many of them there will be, they build back out. That's how we got to 6 at the start of the year here. You can see stocks clearly like it. Then so far this year, we've seen stocks are rising as rate cuts come in because, again, good news, much like we saw here. What's that good news? Well, U.S. economic data is getting better. it was fewer cuts is bad news in the second half of last year because U.S. economic data was deteriorating relative to forecasts. And of course, it's not like we're saying that the U.S. economy was itself deteriorating. No, it was just maturing relative to where people thought it was going to be. And in fact, it was stronger. And the reason we saw that outcomes were becoming weaker, or at least losing their ability to beat relative to forecasts, is because the forecasts were increased. So the bar was raised for U.S. economic data. But then, as data missed relative to expectations, people said, well, in an environment where the data is missing, we need more cuts, not less. So if the data then suggests we need fewer, that's bad news. And if the data suggests we need more, that's good news. But now, at the start of the year, you can see this index has pointedly turned the other way. Now, the data is beating relative to forecasts. Fewer cuts are because growth is looking better. Good. But what have we learned from last year? Is that it's good up to a point until you get to too few cuts for comfort. And so the question now is, of course, if PCE comes out and it beats relative to forecasts, as this would suggest it is tilted to doing, are we going to get to a place where there's too few cuts and the markets swoon? Well, one thing to keep in mind, of course, is that the reason we've had fewer cuts is, again, because the markets have reasoned that a hotter economy means more inflation. And you can see that here. The 5-year break-even rate, which is the bond market's measure of inflation expectations, is sitting at levels that have been unseen since basically October. So we're looking at a 3-month high here for inflation expectations. And not surprisingly, you can see after inflation expectations start to rise, there is, with some lag, an increase in where rates will end up by the end of the year. This orange line going up is showing you that the implied rate for Fed funds at the end of December here is increasing. That's another way of saying there'll be fewer cuts. So, if in fact inflation is hotter, if this rise in expectations continues after the PCE data, which again runs the risk of beating if this is how things continue to develop, well then, perhaps we need to cut into rate cut expectations even more. Now, here's our baseline. The expectation is that we're going to get continued disinflation, that we're going to come into 2.4% on the headline, and that the core number, that's the one that the Fed cares about most, is going to come in at 2.8. Why does the Fed care the most about the core? Because the difference between headline and core is energy and food. And the Fed can't really influence global energy or food costs. They're basically decided by supply and demand on global markets. And in any case, we can see here that goods inflation has been essentially squeezed out of the market. What's left is services. And the biggest contribution within services that the Fed actually has positive agency over, the single biggest contributor is housing, but the Fed can't really do much there. In fact, the reason that housing inflation is elevated is arguably because of the Fed raising rates and pushing both buyers and sellers out of the market. If you're a seller, maybe you don't want to sell because the next thing you'd have to buy is going to be at much higher mortgage rates. And if you're a buyer, because the sellers aren't selling, the price is high and mortgage rates are high. So initiating a new mortgage for a housing market where prices haven't really come down a whole lot feels doubly expensive. So nobody's selling, nobody's buying in size. The price has been locked. And so inflation on the service side is elevated by housing. But until the Fed starts cutting rates, it's unlikely you unlock that. Not a whole lot the Fed can do then. But the other big piece is labor markets. where wages are the sticky inflation point, largely around the big upswell in hiring and the surge in labor demand against the backdrop of about a 3 million now labor shortage post-COVID. So what we're looking at here is really that core number. That's what the Fed cares about. It's progression downward is what the Fed wants to see, because that would tell it that it squeezed the economy enough to get inflation down, and so far it's been able to do it without blowing up labor market. But here's where this gets uncomfortable for investors. Let's say that the PCE number comes in exactly in line with expectations, or it surprises higher, or it surprises lower. Of those three scenarios, if you surprise higher, you need even fewer rate cuts in the outlook. If you surprise lower, you need more, which is probably good news for stock markets. They seem to want more cuts here, or at least that would signal that worrying about this is not something that should hold them back. And if you get something in line, that suggests we're about right-sized for the amount of cuts that are on the board. But this is where things get dicey. Let's remind ourselves right now there are 75 basis points on the board. If we look at what the Fed itself projected when last it updated its forecasts in December, it was looking for a move from a 5.4% average rate in 2023 to 4.6% this year. That's 80 basis points. So the market and the Fed has basically converged. What's more, we can see here that this is a new development. The market, if this is 75 basis points that we're at right here, everything from here backwards is the market being more dovish than the Fed. That's a risk-encouraging environment. That's the market going, the market thinks money will be cheaper than the Fed is saying. So buy assets. Because if the money is cheap, let's go chase returns. Well, now, ostensibly, we've gotten to a place where the money is not cheap, at least relative to benchmark. If the benchmark, as the Fed would have us think, is 80 basis points, we're there now. So any further incremental shift away from rate cuts means the money is no longer cheap. Now it's on the tight side. Now it's on the expensive side. And if that continues, well, then we're in trouble. Then perhaps we get back into a place that we saw at the beginning of last year where the markets go, okay, that's a bridge too far. Let's start looking for weak hands. And they might find them, much as they found SVB last year. And whether and incidentally, whether they find them in earnest or they find them and pressure them because they think they're on to something, and then those things buckle, a self-fulfilling prophecy works nevertheless. Now, as it stands, there's clearly been a significant hawkish shift in the way that the markets see things developing. So right now, we can see the first cut appears to be on the menu sometime in June, July. So if we're currently looking at rates, target rate is 5.33 here. Of course, the Fed sets policy in a range. So what this is the median of 5.25 and 5.5. If you game that out and say, okay, well, what would have to happen here for it to look like we are going to have a cut that's on the menu here? Well, you'd have to come in 25 basis points from 33, so you'd be looking somewhere around here. So the easing cycle now basically on the menu for the second half of the year, give or take. Now, some people have said, well, the Fed's not going to do this against the backdrop of an election. It doesn't want to sound political, but perhaps that's why the Fed has been talking nothing but rate cuts, narratively speaking, saying it's likely we're going to cut this year. It's likely we're going to cut this year on broken record mode since basically November, December, but really loudly since January, as if to say, well, obviously we didn't make this decision on the basis of politics. We've been saying it for a year. So as you look at this, that maybe unties the Fed's hands. So by the time you get somewhere into here, into the second half of the year, this is where the cuts begin to appear. So by September, you get the first one, and you're starting to veer in the direction of a second one here, it looks like, by around November, December, with optionality on a third. Now, if this gets any more tight, and again, consider end of the year here, the rate looks like 4.6. What did the Fed tell us was going to be the rate? 4.6. Now, that's, of course, an average of ranges of forecasts. You can see here, anywhere between 4.4 to 4.9 is the center range, throwing out the externalities, as it were. But as you look at this, again, we're just on that line. We're any tighter than this, and it feels like money is tighter than what the Fed has signaled, and we're on the wrong end of how cheap the money is to buy risk and keep things pushing. At that point, the money stops looking cheap. And then perhaps you've arrived at a level where markets buckle. In that kind of an environment, you would expect a return to this kind of dynamic on the relationship between stocks and Fed policy odds. So just like here, fewer cuts meant higher stocks to a point, and then not, you would expect that same kind of transition here. If, in fact, PCE surprises higher and stocks don't like it. Another place where things have been much more straightforward, more cuts, is a weaker dollar, and fewer cuts is a stronger dollar. Things are very straightforward. Here is, of course, the greenback. It's likely to go higher in the same scenario, not only because higher rates benefit its yield profile, but because if stocks come down and there's risk aversion, what's the most liquid form of cash that people liquidate into? Dollars. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what is likely to follow. I'm back on with Chris for Futures Power Hour on Friday, on with Tom and now Victor, the comeback kid Jones, on Sundays, and opining on the platform formerly known as Twitter at Ilias Pivac. Thanks very much for joining. See you tomorrow.